All right, what is the difference between a traditional IRA and a Roth IRA? That's what we're going to find out today. All right, Kennedy. So you have a bunch of questions for us on IRAs and Roth IRAs. And I know this is a big thing because we have a lot of clients that ask about the difference. We explain it, and then they ask again, and then we explain it, and then they ask again. So it comes up. I mean, we do this all the time, so we know the difference, but I can see how it is very confusing. So we want to kind of go through some of those differences today, talk about some of the pros and cons on each one, and hopefully help you guys out. So Kennedy has a ton of questions, so why don't we get started?
Okay, this should be a pretty easy one to start. What is an IRA? What does that stand for?
All right, so IRA stands for individual retirement account. Pretty simple. That's what IRA means.
Cool.
Did I pass? I passed.
I knew that one, but okay, so what's the difference between a Roth IRA and a traditional IRA?
Okay, so the difference really is how the tax advantage works. So an individual retirement account has tax advantages when you invest. So the traditional IRA is what is another name for just a regular IRA. So traditionally, you invest, you get a tax deduction when you make that investment, and it grows tax deferred until you use it in retirement. And then you're going to pay income tax on the other end, okay? A Roth IRA is opposite of that. A Roth IRA has tax deferral, actually tax-free growth, because you don't get a tax deduction now, you get it invested tax-free for later. So the main difference is when are you getting the tax benefit? And on the IRA, it comes at the beginning, and on the Roth, it comes at the end.
So who is eligible for these accounts?
Anybody that has earned income. So if you have earned income, you're eligible for the accounts, assuming your income is within some parameters, okay? So there are some limits on higher earners on if you can contribute to an IRA or a Roth IRA. And we can put some of these up on the screen because there's quite a range of them. It depends on if you're married, it depends on it, or single, it depends on if you're currently in a retirement plan at work. It changes some of these limits. But generally speaking, you know, the Roth IRA has some higher limits than the traditional IRA. But yeah, if you have earned income, you generally can put in unless you make too much money.
Okay, so like as you were talking, I was thinking, okay, so when I was 14, working in the summers, I could have started
Sure.
an IRA.
Yeah,
Okay.
yeah. If you had some W-2 traditional IRA or earned income, you could do it. Yeah.
Okay.
Yeah.
So the next question was, are there any age restrictions on contributing to either of those accounts?
I mean, there really aren't, as long as you have that earned income. Now, if you're under the age of majority, like in Nebraska, it's 19, you have to have your parents on the account, but it could still be your IRA or your Roth account, and you could make those contributions if you had that summer job or something like that. There used to be some age limits on the upper end. Used to be when you got too old, you weren't allowed to make contributions to IRAs or Roth IRAs. Those rules have changed now, and there aren't upper limits either, so you can still make contributions.
Okay. So what would be the contribution limits for both of those IRAs?
Yeah, so that's we'll put that graphic up, and I think there are a lot of different options there, so we'll kind of flash it up here. But it varies, like I said. If you're married, it's different than if you're single, and generally the Roth IRA has a higher limit than the IRAs.
Okay, makes sense. So how are contributions taxed for each type?
Yeah, so contributions or distributions or both.
Let's do both.
Okay, so I think we're gonna so the money in an IRA is a tax deduction. So right now, if you're under age 50. You can contribute $7,000 into an IRA, okay? You would get a tax deduction on your tax return when you put that money in, okay? So it would reduce your taxes. That money gets invested tax deferred until you use it down the road, okay? So you use it down the road, it's grown to some bigger dollar amount. When you take it out, you're gonna pay income tax then, okay? The Roth is just the opposite. So if you had that same $7,000, you don't get it deducted off your taxes, even though you put it into a Roth IRA. But when that Roth IRA grows, you get to take the money out tax-free down the road.
Okay.
So again, IRA tax deduction on the front, taxes on the end. And in a Roth, no tax deduction on the front, tax-free on the end.
Okay.
And all of these things are assuming that you're following some rules. So there are some rules with these. As long as you follow the rules and you keep it invested until you're at least age 59 and a half or older, those rules, what I just told you applies. If you take it out early, they're going to hit you with some penalties. Okay. So there's a 10% penalty for early withdrawal. And that would apply to the IRA. There'd be a 10% penalty on the Roth. And if you do the Roth, it's kind of a double whammy because it's a 10% penalty. Plus, then you actually owe taxes on the growth. So where it normally would be tax-free, you don't get that tax-free anymore if you're not staying within their rules.
Okay.
And the real reason that is the government set these up for a retirement use, right? So they want you to save it until you are in that retirement age range to use it. They don't want you taking it out when you're 40 years old to go buy a brand new pickup truck, right? They're like, hey, use this down the road. Now you can use it for a pickup truck when you're older, right? But if you're over 59 and a half, you don't have that penalty anymore.
Okay. So can you explain how tax brackets and future tax rates would play a role in deciding between those two?
Yeah, that's a good question. So the one question we get a lot of is, which one should I be using, right? So which is better for me, right? Because you and I might be in a different tax situation. So maybe the IRA might be better for you, or the Roth IRA might be better for me, okay? So I think what's really interesting, and we're going to put a graphic up here that shows this, is let's assume you were going to invest $10,000 into an IRA, okay? Now you can't do that much, but it's even numbers, so we're going to use that for an assumption. All right, so if you invested $10,000, it's invested before taxes, okay? So it doesn't cost you income tax. And let's say that $10,000 is invested for 9 years at an 8% return, okay? And roughly speaking, rough numbers, that will double your money in about 9 years, okay? So your $10,000 now becomes $20,000. Great. You reach retirement age, you take the money out, you have to pay income tax on it, all right? Well, let's say you're in the 25% tax bracket. And let's say we started in the 25% tax bracket and we ended in this 25% tax bracket, okay? And that's the real challenge because we know what it is today, we don't know what it's going to be down the road. But let's say they were the same. So you have your $20,000, you pay 25% taxes, you're left with $15,000 that you can spend then. Okay? So that's how the IRA would work, all right? Okay. So let's flip it around, let's do it with a Roth IRA, okay? Well, the same $10,000, the problem is I don't get that tax deduction. So I have to pay taxes on that money. Right? I got paid 10 grand. I got to pay 25% in tax. So I only have $7,500 to invest after that.
Okay.
Okay. So I am able to invest $7,500 into the Roth, assuming the same 10,000. It doubles in that 9 years to 15,000. But now I take it out and use it, which I don't pay tax on the Roth. So I still have 15,000 when I use it down the road. So either way you did it, you still ended up. You put in 10, you ended up with 15. Well, you didn't put. You put in 7,500, but you started with the base of 10,000.
Yeah.
But you ended up with 15,000 spendable.
Yeah, I think that's what's most confusing. I mean, that's great that they end up at the same number, so it's just kind of like either one's fine. But I just get confused on, okay, do I want to pay the taxes now or later?
Right. Well, and that's a good question because we used a pretty simple example. The fact is you're probably not going to be in the same tax bracket when you take the money out as when you put it in. So you're probably, typically as maybe as a younger earner, right? You're earlier in your career, you're probably in a lower tax bracket. Your earnings probably go up over time as you build your career, and you're probably in a little bit higher tax bracket. And a lot of times when you actually retire, your bracket goes down again. So if you're in a higher bracket now and you anticipate a lower bracket later, then that IRA is probably the better tax situation for you.
Okay.
But if you're in a lower bracket now and you end up thinking you're going to be in a higher bracket later, then the Roth was a better decision. And like I said, the challenge is we know where we are today, but we don't know where we are going to be down the road.
Right. So we're talking about different factors here. So what other factors should someone consider when they're deciding between the two?
Well, I think, I mean, it could depend on what's going on in your life in the year that you're putting the money in. Let's say there are other financial things that are causing your income to be higher than normal, right? That might be a really good year to use that traditional IRA to get the tax deduction. You may have other years where you may have lower than normal income, and then that Roth IRA might be a better decision then because you're not paying you don't have as high a tax bracket going into it. So there's that going on. But I think more importantly is I kind of like having both, right? Because the problem is like I said, we don't know what tax bracket I'm going to be in down the road. So if just like when I talk about investment diversification, if you can build tax diversification into your portfolio, that gives you flexibility down the road. Because if you retire at 60, hopefully you're going to live another 30 plus years, right? You're not going to be in the same tax situation every single year. So if you were able to put part of your money in an IRA, a traditional IRA, and part of it in a Roth IRA, and grow both buckets equally or semi-equally, when you get to the point where you're using it, you get a choice, right? Because maybe taxes are low one year and you say, guess what, I'll take it out of my IRA this year. I'll pay the income tax because I'm not in a high bracket. But 2 years later, it may change and you may be in a higher tax bracket, or maybe the laws change, right, and taxes go up. You could use the Roth IRA then for tax-free. So I think tax diversification is a very powerful thing because we don't know where we're going to be down the road. If we knew, we could decide today, but we just don't.
Okay. So I guess that kind of leads into the next question about is it possible to split your contributions between Roth and traditional? So
Yeah.
you'd have
So you
two.
have both, yeah.
Yeah.
Yeah, definitely. You can do both. You can put 1,000 in the Roth, and you could put 6,000 in the traditional, or vice versa, or any combination you come up with, as long as you don't exceed that $7,000 in any year.
Okay. And that 7,000 applies to everyone?
Once you're over age 50, it goes up by another 1,000.
Okay.
There's a catch up over age 50.
Okay.
Yeah, and we'll put some of the catch-up rules on here as well, so we can put some of the contribution actual numbers, and the reason they change every year. So we're doing this here in 2025, so the numbers are going to be different potentially when this might be seen again in the future. So those numbers do change because the laws change as well.
Okay. So are there scenarios where a person might benefit from converting a traditional IRA into a Roth?
Yeah, so that's a little more complicated concept because you can actually move money between the two of them, okay? So one of the challenges with an IRA is once you reach age 73, you have to start taking what they call required minimum distribution out every year. Okay. So even though you have money in there, the government says, hey, we haven't gotten paid tax on this. We want to get some tax money before you die, right? It's kind of what they're saying. So at 73, you have to start taking a little bit out and paying the tax every year, okay? Well, let's say you never put money into a Roth. You've built up this huge IRA account, and every year you're going to have to start taking money out when you hit 73. Well, let's say you're in your early 60s. Maybe your tax bracket is lower then. You could potentially take money out of the IRA and convert it to a Roth. Now you have to pay the taxes the year that you do that, and change some of the money to be tax-free for later, which is going to do two things. It's going to give you that tax diversification we were talking about that you might not have, but it's also going to potentially reduce that required distribution, which may keep you out of a higher bracket down the road potentially. So that conversion, that would be a reason to convert from an IRA to a Roth IRA.
Okay. I feel like that's a question we get a lot, is that minimum distribution. Well, maybe I don't get those questions because I can't answer them, but you probably get that from some of our older clients.
Yeah, and so I think that's important, and that's a strategy we've been using lately, is just taking a look at, well, where are clients at? Does it make sense to do some of these conversions while maybe they're in a lower tax situation? And sometimes it's great, and sometimes it doesn't make sense.
Okay.
And then it varies, right? Maybe it makes sense to convert $10,000, but it wouldn't make sense to convert $50,000. So we want to look at all the variables there to kind of optimize that strategy.
Okay. So, sorry, I said I had a lot of questions.
You're doing fine.
Can you give an example of a person who might benefit from using the Roth?
A person that might benefit from the Roth is if you definitely are in a low tax bracket now, a Roth would be the prime, if you're in the 10 or 12% tax bracket and have enough income to still put money into a Roth, great. If you're in the 20, right now the 22% is the next bracket up. You're in the 22, you might kind of go either way.
Okay, so like I know from a previous job where the retirement advisor came in, he was really hammering the Roth for me.
Okay.
Can you explain why they would have done that?
Well, maybe he thought you were in a lower tax situation, so it's like, hey, it's a good option for you.
Okay.
And so what you're referring to is just a little bit different because you had a 401k retirement plan. Okay, so you can invest in IRAs and Roth IRAs independent of the 401k plan that you have at work.
Okay.
So you could do those IRAs or Roth IRAs over here, but then you could also potentially do the 401k or Roth 401k at work. So it's kind of the same thing. They have the same tax rules. The Roth 401k is like the Roth as far as the tax rules go. The traditional 401k is like the traditional IRA as far as the tax rules go. So one thing you might think about with a company plan is if the company's matching, their money is always pre-tax. Okay, so you're already building that pre-tax bucket by default. But if you're putting some of yours in as Roth, you can kind of offset that a little bit and grow both buckets if you're trying for some of that tax diversification that we talked about.
Okay.
So I don't know if that's why he would have been promoting it, but that might be one way that you would be looking at it, right? The other thing you might think about is like, well, I need tax deductions because my taxes are high and I don't have deductions and we're a double income family, we don't have any kids or something like that. Maybe it's still okay to do some Roth, but maybe you also wanted to do some traditional. So you might compromise and do a little bit of both along the way because you just don't know where you're at exactly.
Okay. All right, last question. What's the biggest mistake people make when choosing between a Roth IRA and a traditional IRA?
The biggest mistake? Wow, that's a good question. I don't know if there's a biggest mistake, but I think the biggest mistake probably is not getting some professional advice when they're going to do that, right? They just randomly said, hey, my buddy says a Roth IRA is great. I'm going to put money into a Roth IRA. Well, just because they said it doesn't mean it's your situation. So I think the biggest mistake is not working with a professional to know what is best for you at the time that you're doing it.
Okay. So yeah, probably biggest mistake is not being informed.
Not
just
being informed.
Going off someone else's.
Well, not being properly informed.
Yeah.
Right.
Yeah,
just because my buddy
true.
said it, he was informed, but maybe not properly informed.
Yep.
Definitely.
Because everyone's situation is different.
Totally different. Yep.
Well, that's all I have.
All right, that's pretty good. So hopefully we answered a lot of the questions you might have around a traditional IRA versus a Roth IRA. If you have questions, please feel free to call us, send us an email, check in with us. We can answer more questions. And if this is valuable, share it with your friends or family. Subscribe to our channel and have them subscribe as well because we do put out this information quite often, and that'll keep you up to date when there's new information coming out. But until next time, hopefully this helps you.